Welcome back to another weekly episode. So, in this particular episode, we'll discuss the key ingredients that the market needs to move higher. It's important that you understand these 5 points because in this particular year, there will be times when you feel things are not moving according to your plan in terms of stock market, and you need to understand that why. At times, your systems, your techniques, your charts, the way you buy, the way you sell, all may be right at that particular moment. But if the underlying factors that impact market movement are not aligned in your favor, then no matter which strategy you have, your results will be average. So understand these 5 points. It's probably going to help you navigate these challenging times a lot in a better way. So, what leads to higher stock prices in the market? This is what I've selected. And again, it's a theme that is continuing over the last 4 5 weeks that I've done ever since the market have started going through a phase of correction. So, make sure you watch the previous episodes also because everything is linked. The first thing that the market needs to move higher in terms of stock prices is a fiscal policy, a sound fiscal policy. Now, what is a sound fiscal policy? A sound fiscal policy ensures government revenue and spending are balanced to promote growth, control inflation, and reduce public debt. It focuses on efficient tax collection, prudent spending, and fiscal discipline to maintain economic stability. Why I have highlighted this as the first point? Because fiscal policy plus monetary policy is something that prepares a particular country for a bull market that is about to come in the next few years. In India currently, the bull market is already underway. It is just that you're experiencing some midway correction. I'll come to that also. So how do you assess fiscal policy? If you read budget 2024 June July and the current budget that was given by the government, you'll understand that we are on the path to achieving really amazing fiscal stability in our country. I think the fiscal deficit target has been set at 4.4% now or 4.6, I'm not sure. But again, it has been consistently coming down over the last 5 6 years, especially after COVID. Whereas for many other countries, they are still borrowing a lot of money, still spending a lot of money, and their macros essentially are not in place. Now, what is a monetary policy? A monetary policy, that is a sound monetary policy, maintains price stability, controls inflation, and supports economic growth by managing interest rate and money supply. This is essentially done by the central bank, in our case, which is the Reserve Bank of India. Fiscal policy largely is taken care by the central government. When central government and RBI work together, that is when fiscal policy and monetary policy fall into place. And a combination of sound fiscal policy and monetary policy is what leads to higher stock market prices over a period of time. So when point 1 and point 2 are aligned together, that is when you achieve what is point 4, which is the stability of macros. What does stability of macro means? It refers to the consistent and predictable performance of key economic indicators such as inflation, GDP growth, fiscal deficit, exchange rates. It ensures a balanced economic environment, reducing volatility and fostering sustainable growth, investment, and employment. Why I have written this? Because both the RBI policy that was concluded recently, that is on Friday, and the government budget that concluded on 1st Feb, both highlight the importance of dealing with stable macro conditions. And never ever in the last 20 25 years in the stock market have both fiscal policy and monetary policy aligned in such a perfect manner. And that is why you have seen post-COVID, India, especially between the emerging market, has performed amazingly well. Again, what you're seeing today is a result of that performance, which is covered in time and price correction. So what leads the market higher? It is the stability within the fiscal policy, monetary policy, which leads to stability of macros. But there are two key ingredients that are required, especially in emerging market. That is point 3 and point 5. I'll first come to point 5. See, whenever market has to move higher, it needs two essential things. Number one, leadership. There has to be a leadership in bull market. Between 2020 and 2024, there were n number of sectors and sub-industries that came forward and took the market higher. You need group of sectors to come forward that stabilize the market and only then seeds are sown for the next bull market. Now, there is one key element here. Bull markets also tend to develop after a sustained period of time or price correction. See, what is working against India today is not our macros. Our macros are sound. Yes, growth is tapering off a bit, but that is natural in a large economic cycle. But what is working against us is that over the last 3.5, 4 years, yes, the valuations have increased dramatically, especially in the small mid micro cap space, but we are also coming on back of a huge stock market boom. Whenever you've had periods where in the last 2 3 years index has moved 25 30% compounded plus, I'm talking about the small mid micro cap space, it becomes incredibly difficult for that performance to repeat itself no matter what fiscal or monetary policy you have. So we need time and price correction that is currently going on in our market, which is amazing news for the next 12 to 18 months. But there is one more key ingredient that is required, and that is global conditions for equities. Emerging markets tend to perform well during low global interest rates, strong global growth, and ample liquidity. This attracts foreign investments. Favorable macro conditions include stable inflation, fiscal discipline, a weak US dollar, and controlled commodity prices. So, the reason why I'm not bearish on India and being bullish does not mean buying a lot today, it means you're open to new stock leadership that may set up over time. The reason why I remain bullish is because we have favorable macro conditions, we have stable inflation, we have fiscal discipline. The only two things that are not working for us is a weak US dollar. Currently, dollar is gaining a lot of strength. That is actually, making investors pull out money from India because obviously investments in the US get a lot more attractive, and we don't have relatively controlled commodity prices. See, whatever President Trump is doing in the US, it's going to be super bullish for India, but it is going to take time. It is going to take time mainly because of what we discussed in point number 5. Today, the dollar index is seeing a lot of appreciation, and such cycles typically don't end so soon. So that is why we are currently undergoing a phase of time and price correction where a lot of stocks that are run up 4 5 6 7x are finally correcting, and that's going to give you amazing opportunities in the next 12-18 months. So what I'm going to do is I'll take you through some charts. First, I'll cover the time and price correction aspect just to see that whether there are some sectors that are setting up that are trying to provide leadership. None of these sectors have confirmed leadership yet, but the signs are good. And then I'll take you through some charts that will highlight the conditions of this third point, which is global conditions for equities. I won't discuss point 1, point 2 because I hope by now you've gone through most of the videos that have discussed about how good the budget was, how fiscally prudent the government is. So I'm pretty sure you're well aware about that. First sector is Nifty IT. Again, this is weekly time frame chart, simple candlestick, and simple relative strength ratio chart against Nifty 500, which is the broader market index. A clear relative outperformance is still there in Nifty IT. Yes, it is not moving up a lot, but you look at these candles are not that negative also. Previous pivot is marked, and price is currently just pulling back within that pivot. So today there might not be a fresh opportunity, but I think IT should be on the radar. For the same reason, I think you should also have Nifty India Digital. Has many similar stocks from Nifty IT, but again, look at the clear relative strength. This is also a sector that has to be on your radar, that is showing some signs of leadership, but not confirmed it yet. Nifty Pharma, coming back within these trending pivots. The structure is fine. It's forming a lower high currently, but look at the relative strength. Amazing. This tells you that the sector is trying to fall less as the market was volatile. I won't repeat for healthcare. It is exactly the same chart. Same kind of things you can see. Strong RS, trending RS. Price did make a new high here. It is pulled back. It is pulling back in these trending pivots. The weekly structure still seems fine. One dark horse emerging is Nifty Financial Service. This is different from banks. Financial service has some banking stocks, but it also has some stocks which are in the lending space. So you can just check this index out. Recently, the relative strength of this sector has started moving up, which means it is trying to outperform while falling. Mind you, it is still not moving up. The structure is still lower high and lower low. But there are some green shoots that are visible in this particular sector. I'll come to that towards the last slide in this video. But this sector, along with banks, has the potential to actually take the market higher whenever you get a rally on the upside. And remember, 2025 is going to be that year. I think half part of 26 also, where there will be a lot of frequent rallies on the upside and the market will again roll over and fall. Again, there'll be rallies on the upside. I won't repeat this. This is something I've already covered in the last couple of episodes. Consumer durables is also one sector where I'm spotting relative strength is okay. It's again pulling back within this particular pivot. It's actually the least strongest kind of sector within what we have discussed just now. But still, I've just put up this sector because the budget will have an impact on this particular space, which will show up in the next couple of quarters. So this particular chart that you see is the weekly chart of dollar index, and it relates to the third point that we discussed in the first segment of the video. If you look at this, dollar index is actually forming a long base. This is a chart I'm covering almost every week because it remains so important for emerging market, more so for India. If you look at this, dollar index currently is fluctuating between 107 and 110. If we remain this way for the next couple of more weeks or 2-3 weeks, I think then odds of Indian markets actually staging some sort of comeback will increase. Currently, I do feel the structure is just about right for a relief kind of rally to develop. What happens with that rally, you'll only come to know over a period of time. But dollar index should not go past 110. If it stays below this level for the next 2-3 weeks, you will see some kind of rally developing. But again, it is very clear that it is breaking out after a long base, and whenever dollar index strengthens, currently it has moved 10%, you're seeing what kind of selling has come in the market. If it were to go towards 120, 121 later in 2025, Indian markets will surely go and make one more new low. So that is the global market context that we have. Monetary policy is good, fiscal policy is great. We are currently undergoing time and price correction, but the overall global macro currently is not supportive of emerging market. The next chart is of S&P 500. When you're getting such amazing opportunities in the US market, given what dollar index is doing, why won't FIIs pull out money? And this is the reason. Look at the relative outperformance in September that S&P is putting in against our broader market. If investors are getting low volatility, higher returns in America, they are not going to return to India so soon. And all of this is because of what dollar index is doing. The next chart is about emerging market. Emerging market, if you see, is in a broad range since 2010 and currently it's 2025. In between, we did see some attempt here, but again, that rally fizzled out. So if dollar index is to stay within the range of 110 to let's say 105 for the next couple of quarters, I think emerging market initially might pull back, but it will test out this level of 52, 53. If it starts going above 54, 55, 56, you should look at the dollar index then. If dollar index starts breaking down below, let's say 105, 104, 103, that would actually signal a start of a new kind of bull cycle in emerging market. I, for one, don't think that it's going to happen so soon. That is a sustainable rally in emerging market. But again, funny things happen in the stock market, so you must always be tracking these data points. Now, this particular data point highlights the 10-year yield of India, Japan, and USA. You have to understand why I've pulled up this data. So you might be hearing in the media that as US 10-year yield rises, emerging market tends to underperform, which is absolutely correct because money keeps going abroad. That is, it's being pulled out of emerging market back to the US. And I won't repeat those points. But if you look at our 10-year yield, it's been consistently moving lower. If you look at the trend of it over the last 18 odd months, despite of everything that is happening in the world, our 10-year yield is relatively stable. It's stable because our overall macro, the fiscal part and the monetary policy part is moving in the right direction. When our yields begin to spike, the cost of doing businesses for a lot of company increases. That is why it is so negative for equities. But leaving aside what is happening in the global market, both in the US and in Japan, our macros are in the right kind of structure. We just need some support from dollar index. We need some support from money coming back to India via FIIs and FDIs, and you will quickly see our markets changing colors. But overall, whether it's our fiscal policy or monetary policy, things look good. Now, coming to what is bothering India in terms of foreign investments. If you look at this chart, this is major currencies in the world and what they've done since Jan 1st year to date. India is depreciated 2.59%, whereas look at other currencies in the world. Now, this is what has caused foreign investors to pull out a lot of money. Because the moment when they come at, let's say when the currency was 83 or 84, and they see currency reaching 87, 88, they are directly taking 4-5% loss on their investments even without the market doing anything. All right. So currently Indian rupee is at what, 87.6 or 87.8. I don't know the last level. I feel that somewhere between 89 to 91 is where foreign institutional investors will again start thinking about bringing money back to India. We are already seeing that the selling is reducing every day, which is a great sign. But I think if the currency depreciates to somewhere between 88.5 to 90.5, that is where you could see foreign institutional investors returning. And yes, we need their money. For far too long, domestic mutual funds have told you that retail money is enough for our stock market. That is just not true. We need every bit of investment that we can get, whether it is retail, whether it is HNI, whether it is ultra HNIs, FIIs, FPIs. Every bit of money is required because at end of the day, it benefits all of us, that is traders and investors. Now, this particular chart is a chart for all Nifty 50 stocks, and it tells you about the lack of leadership currently in the market. So just pay attention. As of now, we have covered point number 3, point number 5, and this is part of point number 5, where I'll show you why leadership currently is missing in the market. So if you look at this chart, this is a chart I'd also shared on Instagram midweek, where I was explaining why Nifty Bank and Nifty are currently capped because of the kind of leadership that exists within these indices. If you look at Nifty 50, what is trying to take the market higher? You look at Bajaj Finance, some bit of Maruti is here, Wipro, Titan, Bajaj Finserv, Tata Consumers, Techem, Nestle, JSW Steel, Grasim, Power Grid. Then we have Hindalco, BEL, Unilever, Infi. But look at where the heavyweights are. ICICI Bank, HDFC, TCS, Reliance. You look at SBI, where is State Bank of India, ITC, Sun Pharma, Axis Bank. All these heavyweights are still languishing in terms of price strength, in terms of performance. Whereas what is essentially trying to take the market higher are those names which have not essentially delivered amazing returns over the last 3-4 years. This is typical sector rotation that is happening in the market. Can some of these names become massive winners in the next 3-4 years? Yes, but that will only come about when you have a pullback where these structures don't give up the kind of gains they have had in recent times, and then they begin the next leg up for the market. I still feel there are a lot of heavyweights here that need to get into the right kind of structure. They're still languishing a bit. Every time they try to move up, you see some kind of supply coming in the market that keeps a cap on Nifty. I think once the kind of year that we are into, I think +7, +10% rallies will keep developing in the market, and over the next quarter that those rallies will again fail. That is the kind of market we are into. And this is the whole problem. We don't have leadership because stock market has delivered really strong returns in the last 2-3 years, and those previous leaders are cooling off. Whereas those stocks that did not function in the last 2-3 years are trying to move up, but because they were languishing so low in terms of positioning of traders and investors, these stocks still don't have that kind of firepower to take the index higher to, let's say, a new 26-week high or a 52-week high from this particular stage. I remain bullish on our market, but it does not mean I'm buying a lot. I'm adding stocks to my watch list. I'm trying to identify which sectors are getting into the right kind of structures, which stocks I need to have on my watch list. And then eventually, one fine day, you'll start seeing some of these sectors setting up. They are moving above this particular range, breaking through resistance, and probably that would give birth to a new bullish cycle in a market. I do think we are going to be in this particular range bound kind of a market for the next few more months, few more quarters. It's going to be a struggle, but you got to do your homework, because as I said in the earlier part of the video, stock market is funny. Nobody can truly anticipate what the market can do, and many a times you just see rallies developing out of nowhere. So let's see how things go. Keep doing your homework. Keep which sectors are at least holding up well in terms of relative strength. Those are the sectors where you should be focusing, and keep tracking the dollar index and what emerging markets are doing in general. All right. So I'll see you next week. Take care and be safe.